As a VAT registered business, you have certain obligations placed on your shoulders, certain obligations that you must carry out and comply with if you were to avoid falling foul of the tax authorities, namely HMRC. In this video, I'm going to give you an overview of what those obligations are. I'm going to talk to you about the different types of supplies that exist in the VAT world, what conditions you need to satisfy in order to claim back any VAT that you paid out to your suppliers. We're going to be talking about what's called a VAT return, what the composition of that VAT return looks like in very basic terminology, and the records that you must maintain and keep, and making the payment over to HMRC accordingly. Hi folks, welcome to another week. Hi folks, welcome to another weekly video on my I Hate Numbers channel, the channel that's there to put you in touch and get closer to your numbers so you can make more money, improve your mindset, save tax and time. Please remember to subscribe to the channel, share the video, give me some feedback and some love. Let's crack on with the video. Now, there are four types of supply in the UK as they resonate with VAT. They are standard rated supplies, they are exempt supplies, they are supplies that are outside the scope of VAT, and the fourth one within standard rated is what's called zero rate. Now, what do they actually mean? Now, it's probably best to explain exempt supplies outside the scope, and then we can revisit and talk about the standard and the zero rated supplies. Exempt supplies, typically things like the sale of insurance and financial product, the provision of health services by a doctor would be what's called exempt. The implication of that, there is no VAT charged on that, and there is no VAT that you can claim back on those supplies. In HMRC world, by the way, we don't use the word sell, we use the word supply. So any exempt supplies means also that it can restrict the amount of VAT that you can claim back. More of that later on. The other type of supplies are what's called outside of the scope. So if you're a mechanic providing MOT services, MOTs are outside of the scope of UK VAT. The sale of goods overseas outside of the UK typically is also outside of the scope of UK VAT. What that means is it does not go onto the UK VAT return. The other two are coming under the umbrella of what's called standard rated, and potentially VAT will be applied. The simplest thing is if we think of what's called zero rated. What this is an example like the sale of children's clothing, certain printing and stationery items, and those items are zero rated, which means no VAT is charged on those, the rate is 0%. The last category is what's called standard rated, and the default rate that's charged typically is 20%. Now, what's the relevance of that? Let's look at the next thing, and that comes back to claiming back VAT that you pay out to your suppliers. Now, you will buy in goods and services, you will buy in product, you will pay out people's wages. A whole variety of costs are incurred by your business. The general principle being that if you've got supplies which are called standard rated, so you are a public house, you're selling pints of beer, you're selling a round of drinks to your customers, those are standard rated supplies. 20% would have been included on the value of that supply. When you buy in goods to resell on, you can claim back all the VAT in respect of that. Now, let's look in terms of what the conditions are when it comes to claiming back VAT. As a bare minimum, if you claim back any VAT from a supplier, it's critical that you must have at least the VAT number of that supplier. Even if the amounts are involved are quite small, you don't necessarily need a receipt, but you do need a confirmation of that VAT number. You also need a description of the goods and services that you're buying in order to legitimately claim back the VAT. Now, we then come to each quarter, typically, you'll have to complete a form. It's called a VAT 100 form, where you will include, or your software will certainly do that, it will populate that VAT return, and typically there are 9 boxes to complete in that return. Box number 1 is the amount of VAT that's called output VAT. That's the VAT that you've charged to your customers. You'll aggregate that figure, and that goes into box 1. Box 2 for a fairly simple return is not relevant. That typically relates to what called overseas activities, so we can ignore that for the purpose of this video. Box 3 is just box 1 and 2 added together. Again, depending on how you generate your VAT returns, whether they're through HMRC system or your own software, then that will be automatically calculated. Box 4 consists of all the VAT that you're claiming back on your suppliers. So when you're buying goods and services to sell on, assuming they relate to making those taxable supplies, you can claim back the VAT on that and all that VAT goes into box 4. Box 5 is typically, it's doing a seesaw. If you've got output VAT, for example, of £5,000 and you paid out VAT of £3,000, then you pay HMRC £2,000. And that's the amount you have to pay over. It sometimes does happen, it goes the other way round, that you don't charge that much VAT on your sales in that month. Maybe sales are slow, but you bought a lot of items in, lots of goods, lots of equipment. Therefore, you've got more input VAT than output VAT. You'll get a refund back from HMRC. And therefore, that box represents the refund that HMRC will give you. Typically, we've got 2 real boxes that are relevant for a basic VAT return. Box number 6 is the value of the sales that you have made, excluding the VAT that will be included in there. Now, it's a good thing to remember. On that figure there itself, that would include exempt supplies, that would include 0 rated supplies, and it will also include standard rated. So therefore, you must make sure include all the value of those sales there. Towards the end of this video, I'm going to mention something called reverse charging, which is important to know. When it comes to effectively box 7 is the value of all the purchases that you have made, whether they're exempt, standard rated, 0 rated, acquisitions, purchases, then you include that into box 7, exclude the VAT from that. Box 8 and 9 typically will relate to EC Northern Ireland acquisitions, dealt with slightly differently, and that's your VAT return. Now, before I conclude, let's think about what is called reverse charging. Now, if you have an overseas supplier who supplies goods to you, you're a VAT registered business, that VAT registered, then typically those supplies will be what's called reverse charged. So you may have a German supplier who's doing some SEO translation for you, some specialist work. If that value of that service is £100, in the UK, you would add 20% to that, and that would be £200 worth of VAT. In reverse charging, which you must state on the invoice here, you will add £200 to the output box, but in the same breath, you'll also claim £200 as input VAT. There's no money that changes hands, but it's your responsibility to account for that VAT transaction as though you had made the sale. Last thing to mention is that when it comes to the submission of the VAT return, typically it has to be done 1 month and 7 days after the end of your VAT quarter. Money has to also be paid promptly, otherwise you run the risk of entering what's called a penalty regime. Folks, just come with me and I'm just going to run through a brief illustration now of what they look like with the visuals and some numbers. Let's have a look at the typical documentation that will be issued and circulate in a VAT registered business. So we have, first of all, the invoice that would go out to our customers. Notice it's got to have an invoice date. In strict tax terms, it's called a tax point date. We've got the reference number. Key other ingredients is a description of the goods and services. Here is adult clothing. The VAT number must be quoted. The address of our sales and the address of our customer. We've got the breakdown, the itemisation, the identification of the VAT that's being charged and the appropriate rate. We're giving out a discount to our customer. The VAT is applied on the discounted value. £7,500 is what we expect to pop up into our bank account. Now, on the other side, we've obviously had to purchase goods for resale. This is our supplier. Usual things here, make sure we've got a VAT number that's been quoted by the supplier. We've got an identification of the item concerned with the description. We've got the supplier's address, our address, we've got the tax point, the invoice date that's been quoted, we've got the identification of the VAT, the gross amount that will leave our bank account to pay the supplier is £3,000, the value of the purchase is £2,500, and that's £500 worth of input VAT. Again, key things are description, tax point date, VAT number, a bare minimum of the items that we'd expect to see on an invoice. If you don't have those, strictly speaking, you cannot claim the VAT. When it comes to the VAT return side of things, we look at what's happened and we've got purchases, i.e. goods for purchase for resale, services that we have to run our business and overheads. Now, those will have VAT attached to them. We call them input VAT. Not every supplier that we have will have VAT added onto them. The supplier themselves may not be VAT registered, or they may be providing services for which VAT is not due. On the other side, we've got goods that we're selling on. We classify them as either standard, where 20% will be charged as a default rate. There are exceptions, but in the main, 20% is the headline rate. 0 rated items, typically things like children's clothing, will be one such example. Certain items of food would also be 0 rated. Exempt, certain educational supplies, would be exempt. They would still go onto the VAT return, but there's no VAT attached to them. And outside of the scope, that's outside of the scope of UK VAT, they would not enter on the VAT. We identify the VAT attached to those in terms of what we've charged customers, what we've incurred to suppliers. Any VAT on those first three that relate to standard or zero rated is fully claimable, subject to one or two exceptions. Any VAT that's been incurred in relation to making exempt supplies, so you sell insurance services, you've got legal fees in respect of drawing up some basic ingredients, then what will happen is the VAT on that initially will not be allowed. And any VAT on outside of the scope supplies is not claimable. All of those figures are assembled, the value of the VAT and the value of the related purchases and sales, and go on to the VAT return, which we're going to have a look at in a few moments. Reverse charge, services from overseas, that business is VAT registered, you are VAT registered, then VAT reverse charging will apply. In other words, you step into the shoes of the supplier and you assume that you sold them to yourself, so you will charge yourself VAT at the standard rate, and you will also claim it back in the same breath. So no money changes hands, but you have to declare the output and the input VAT. So for the example of a German specialist that we procure the services of to do some SEO work, we've got a customer base in Germany, they charge us £500. We would then charge VAT at the appropriate rate of 20%, include that into our VAT return, and also claim back the VAT. As other things like Google ads, Facebook ads are again common examples of services that we procure which are subject to reverse charge. And when we come to the VAT return, this is what's going to happen. We're going to look at the different items that we've heard during the course of the period. So we've got everything from adults clothing, children's clothing, wages, marketing, insurance, accounting and equipment. We classify them accordingly. So adults clothing is standard rated at 20%. Children's clothing is zero rated, and the rate is obviously 0%. Wages are outside of the scope of UK VAT, should not go into the VAT return. Marketing, standard rated supply, we have a situation where we're paying 20% to our marketing agency. Insurance services that we procure are exempt, they still go on the VAT return, but there's no VAT that we can claim back. Accounting services are standard rated supplies, and we pay our accounting team 20% on their invoice. And equipment purchases are standard rated 20%. There's some figures that we've got. That's the gross value during the quarter. So that's the value of the purchases inclusive of the supplier's VAT they've charged us during the last quarter. Now on the sales side of things, we're selling two products here, adult clothing and children's clothing. The value, they are standard rated supplies for adult clothing where we're charging 20% to our customer. The children's clothing that we supply is zero rated and the rate we charge is zero. Assume the value of the invoices we've raised during the quarter in gross terms is 18,750. That includes the VAT that we've charged to our customers. And the children's clothing, that's the gross value of the invoice, and that's the amounts we'd expect to see coming into our bank accounts. Now what does all that look like? For our business, the I Hate Numbers closed business, for the VAT return quarter, 1st of June to 31st of August, these are the main headline things included. Now this is being generated via a piece of software. Xero is the one that's being used. Most of the other systems that we adopt are much of a likeness. Key thing is we have the VAT number that we're quoting. We're accounting for the VAT under what's called normal basis, i.e. the VAT is captured based on the VAT dates on the invoice. So during that quarter, we've got total sales, the output VAT of all those items are 3125. That goes into box 1, and it also becomes the total in box 3. In this example, we're assuming no overseas or EU or Northern Ireland sales or purchases. Box 4 is the value of the input VAT on all the purchases we've made. And in box 5, that's the difference between the two. In this example, there's more output VAT charged than input VAT. Therefore, we owe HMRC 737.50. Boxes 6 and 7 is the value of the sales we've made excluding the VAT that's charged. So that would be standard rated and zero rated sales that have made. That goes as 25,825. Box 7 is the value of all the purchases we made, exempt, standard and zero rated. That's the value excluding the VAT that's been charged, and that's 18,808. Box 8 and 9 in this example are 0 because there's nothing that's happened with the EU. As a headline, by the way, folks, HMRC typically take box 6, apply a compliance test by applying 20% to see what it looks like compared to what's in box 1. Submit that VAT return. Now for the quarter ending 31st of August, that's going to get into HMRC by 7th of October 2021 with, if there's money owing, cleared funds have been made and the payment has cleared the system by the 7th of October 2021. Okay folks, hope you found that useful. Give me a thumbs up, share some love, give me some feedback. Until we meet again next week, have a good week.